We got further evidence from economic data today that the economy is weakening. It is Wednesday, June the 4th, and this is Markets with Megan. If you like this podcast, please subscribe, hit that alarm bell, and you can share with friends, family, or colleagues. But we're here today to talk about the ISM Services Index. And this report is definitely an important report, one that we follow closely because it measures the activity in the service sector in the U.S. economy. And that is where the majority of our money is spent in the U.S., is on the service sector. Now, this report showed that the service sector contracted for the first time in 11 months in May. And when we talk about contraction, it's when this index comes in at a level below 50. It came in at 49.9, which was also weaker than was anticipated. It was expected to actually increase to a level of 52. So let's dig into what drove this report lower. First of all, it was new orders. We saw new orders contract significantly, all the way down to 46, which is very well into contraction territory. And it was the worst reading on new orders since December of 2022. We also saw some evidence of an inventory overhang, and this is concerning because if there's too much inventory, you see businesses actually reduce inventory, and that actually detracts from economic growth in the future. We saw that the backlog of orders declines, meaning that that backlog of orders are being cleaned out, and then inventory sentiment actually rose, meaning that inventories are higher. So there is evidence of this inventory overhang. The biggest concerning part of this report was in the prices paid component, and that is an inflation indicator. We actually saw that rise significantly for the month. It was the highest level we've seen since November of 2022, and that's when we were really in the depths of some of the inflationary pressures we had after COVID. And it was also a time when the Fed was raising interest rates. Now, what does this mean for the markets? The markets actually are relatively unchanged today. Bond yields are lower, meaning prices are up. And that's because with this weakness now in the service sector, it means the Fed might have some flexibility to cut interest rates in the second half of this year. The other thing is that the equity market is really just waiting for the very market-moving event we get later this week, which is the payroll report, and that will be on Friday. That's all we have today. If you want a history of our podcast, you go to marketswithmegan.fm. Thank you.